You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. All right, so we're getting to the end of earnings season. Seems like we've said that a lot. We still keep finding a few stragglers that are of interest that we can talk about and look at specific plays for. So we, a couple of weeks ago, had a very good conversation around Costco's earnings, and we looked at an iron condor and we looked at a butterfly, and both of those trades turned out to work pretty well. So we stuck with the butterfly concept and we did one in FedEx. So we're going to look at a butterfly, and then I did find out that Nike is going to be announcing earnings today we are taping Options Playbook Radio, I should emphasize, on the 21st, which is a Wednesday, and the markets are open at this point in time. And Nike is going to be announcing earnings tomorrow, which is Thursday, and they're going to be announcing after the close. So they're going to be announcing on the 22nd, Thursday after the close. So we'll look at a trade of Nike, but as always, nothing's meant to be a recommendation on Options Playbook Radio. We're just trying to learn. We're trying to look at different scenarios and trying to apply the Greeks to our option strategies. So let's talk about the FedEx trade from last week. Well, when we looked at FedEx, unfortunately, we always tape either on Tuesday or Wednesday. When we looked at FedEx, earnings wasn't right around the corner. They just came out and they announced earnings on the 20th. So they just announced earnings yesterday. And today we currently have on the 21st, we have them trading, and the stock is trading up a little bit. It's not moving as much as expected. Now, when we put on the trade, the date of the trade, or when we taped Options Playbook Radio, was after the close on March 14th. And we did say that normally you would wait to put on the trade. But on March 14th, here's the trade that we did. We went out and looked at a standard at-the-money butterfly. So the market was at 246.91. We went wide on this one. We went 15 points. So the lowest strike call, our one of the wings that we bought for protection, was the March 23rd, the closest expiration, 232.50 strike call, 232.50. And then we went 15 points up and sold two of the same expiration, 247.50. And then 15 points up higher, and we bought the last protective call, and that was the 262.50. Now, that was 15 points wide, which is a fairly wide butterfly, but we have an expensive stock. The stock, when we put on the trade, was at 246.91. It was down $3.86 on the day. We were able to execute at the midpoint, at least execute on paper, because it was just a paper trade, for $6.48. So it was a little bit expensive relative for a butterfly, but we were going 15 points wide. So with the 15-point wide butterfly, if you take 648 minus 15, that means your maximum upside would be $8.52. We never want to stay and try to get the maximum on butterflies. We're always going to try to get out. And our maximum risk would have been that $6.48. But we were looking for a very big move in order to lose all that. The expected move based off of that day, once again, we still had an entire week before they're going to announce earnings, was 11 points plus or minus on the trade. That's why we went 15 points out. So now the market did open, and it's trading right now in FedEx, and we actually have FedEx right now at 254.57. That's where the market is at. And the market at the time that we put on this trade was quite a bit lower. Now, if you would have put the butterfly on the day before, which would have been yesterday, right? It closed at 251.99, or we could call it 252. So the expected move hasn't even came close to getting touched on this. If we centered around 252 yesterday, this trade would have been a very good trade for sure. And as it is, based off of what we did last week and the $6.48 that we would have paid for it, this trade would still be a winner overall by just putting on this trade and not getting the expected move. So our break-even points based off of the strike prices that we talked about last week would be the lower strike plus the debit or the higher strike minus the debit. So in theory, if this thing stays anywhere between 238.98 and 256.02, say that again, the break-even points were 238.98 and 256.02. And right now it's at 254.81. It has traded higher. It traded up to 258, but it didn't stick there long at all. It didn't hang around, came right back down. It's really been hovering right around the $255 range, right in that range. It opened today not much higher at 252.25. So it hasn't done much. And based off of that, we've had implied volatilities come back in. And this trade right now, if we closed it out, would be a profitable trade on paper. Right now, we could sell to close the legs of this trade with the market open and running and the implied volatility coming screaming down because we just haven't had much of a move at all in FedEx after the announcement. That means we would be selling to close the 232.50 strike call, buying to close the 247.50 strike call, and then selling to close the 262.50 strike call, 1 by 2 by 1. That would be closing out that butterfly. And we could sell it right now for $7.20. It's bouncing around at the midpoint. Let's call it $7.20. We paid $6.40. So the market has moved quite a bit, and it's still a very profitable trade. And as far it's moved since we put that trade on last week. And don't need to emphasize again that we probably would have put it on yesterday as opposed to last week. So even though we put it on last week and we paid a hefty premium, $6.48, we did it 15 points wide. And this trade would be profitable if we closed it right now as we tape Options Playbook Radio. Nothing meant to be a recommendation, but interesting trades. So we've had quite a few butterflies, and a lot of people don't think of a butterfly as the neutral trade that it is. They instead of doing iron condors, especially around earnings, especially on expensive stocks, which I'd consider FedEx an expensive stock, $250 some odd dollars. And when you're looking at it, it provides a lot of flexibility also on that trade. Now, when you're doing it with just 1 day remaining to expiration, it's an all or none basic trade. You do have a day to trade out of. There are some things that you could potentially do. And some of the premium, if you were dead wrong and it made more than the expected move, we had an 11-point move. We were 15 points wide. So let's say it opened up 18 points, 19 points. You could still get out and probably not have the max loss as long as you just got out and you reacted right away as soon as the market was open. All right. Well, let's do another one. Let's look at. Okay, so we did butterfly. We did an iron condor. So that was 2 weeks in Costco. We did another butterfly in FedEx. Let's get crazy and let's look at a more volatile trade. Let's look at something where we really want the underlying to move. And we're going to do it on a lower price stock. So this won't be as an expensive a trade. And that's usually the case. When you're doing even advanced strategies and they're lower price stocks, you usually can get away with less requirement. Overall, your spreads aren't as wide, or lower debits if you're ended up paying debits as opposed to selling, receiving credits, and having requirements. So we're going to look at Nike. Nike is, as I mentioned, going to announce earnings, and we're going to look at a back ratio spread in Nike. Okay, we're going to do it on the call side. Doesn't matter. You flip a coin. I have no opinion, no idea what might happen to Nike after earnings, but we're going to go a shorter term. We're not going to go that far out in time, and we're going to look at a shorter term call in Nike. All right. So where do we got to start? Okay. Nike is going to announce earnings after the close tomorrow. So if I was doing this trade, I might wait until tomorrow, but it's not quite as important because we're looking for some more volatility in this back spread trade. But I would probably do it tomorrow. I'm going to stick in the nearest term option contract. I'm going to go 2 days on back spread, something where I'm looking for more volatility. I don't mind going out an extra week around an earnings play. That's okay with me. But I'm going to go look at this back spread where I'm going to sell one call to try to pay for 2 other calls. It will be neutral to bullish. So if the market just stays where it's at, or if it goes down even, we're going to bring in a small credit and we'll just basically get our commissions back on the trade. I like to think of it as I don't want the cheese anymore. Just let me out of the trap, that type of scenario. But if it goes on up, we want it to skyrocket it. And this is a play that you would do if you think the market is going to move more than the expected move. I think the retail here in this instance, it has more chance for volatility, so I don't mind doing it. We got a couple others that are going to be announcing. Lululemon is going to be announcing next week, so we have some of that's kind of in the same retail world as Nike. But Nike's announcing tomorrow. It's a $67 stock. It's up 23 cents on the day, so let's do this. All right. So first thing we always do is look at the expected move, which is buying the long call, buying the long put, right at the strike price. Stock's right at 67, so it's fairly accurate here. We're looking at about $3.40 at the midpoint on each side. It's trading at 72% implied volatility. So when we're doing this trade, we're looking for more than the expected move. So we're going to go on out. $3.40 plus 67 puts us right at $70.40. So we want to be somewhere around that because we're looking for a bigger move than that. So I am going to sell the 70 strike call, and I can move up a point and a half, and I can buy from the sale of the 70 strike call, I can buy 2 of the 7150 calls. So we're really hoping that this thing will move at least double the expected move. We're looking for it to move closer to 6 points. And if it does, then this trade should be fairly profitable to do based off of earnings coming tomorrow and the expiration at the end of the week. So let's set it up, and I will give you the full perspective here. So we are looking to sell the smaller or the closest to the money strike, which would be 70, and then we're going to buy the 7150, and we're going to buy 2 of them. So we have the March 23rd expiration. We are selling to open 1 of the 70 strike calls, and then buying to open 2 of the same expiration 7150 strike calls, and we can get this done for a net credit at the midpoint of 5 cents. Not always guaranteed a midpoint fill in a trade, but we could possibly pull this one off at 5 cents. I'd like to get a dime if we could, but it's not always. I don't think we'd get filled at that range. And the way the profit and loss graph looks then from this is if the market opens and it does not move or it moves down, that credit received is what my maximum gain would be on the trade. The most that I could lose on this trade is if the market went up to 71.50 and it went exactly to 71.50 and it just sat there and I stayed all the way till expiration. I could lose $1.50 on this trade if it pegged right at 71.50. And but I get a 5-cent credit, so I'm not quite. I could lose $1.45 would be my maximum. And what I'd really like it to do is just open up beyond 71.50. If I can get it up to 72, 73. You're talking about more than the expected move. It doesn't happen very often, so I just want to have realistic expectations. But when you get a stock that makes that type of move, this is a fairly low-risk strategy that allows you to hit the home run if you are correct. If it skyrockets, goes up 6-7 points, or it does double what's expected, which has happened around earnings on different other stocks. It's possible, but it's not plausible that it's going to happen, but it's possible that it could happen. And that's this type of trade. So when you're looking at these trades, you got to have realistic expectations, and that you can do a lot of them. You can manage your risk with them, but you don't usually think that you're going to make money on them. But if you do them 10 times on maybe 1 out of 10, you might get one that moves triple the expected move around earnings, depending on where you're at. And you want to pick your industries that you're doing them in. Tech stocks obviously have been flying. Amazon was up 100 points after earnings in one of them. So these are the type of trades that you got to think really long and hard about. But if you manage your risk, the most that you can lose on this trade is $1.50 for every 1/2 back ratio trade that you put on. Now, the other thing about this trade is, and I kind of like this name, in the playbook, we call it the back spread with calls, and that's on page 84. Now, if you want to do it with puts, you can also do it with puts. You'd set it up pretty much the same way. Go out about the expected move, and that's where you're going to put the strikes. But if you want to do it with puts, it's page 87. And sometimes with back spreads, it makes sense to do them with puts if you're setting them up this way, because stocks have a tendency to move down quicker and faster on the downside than they do on the upside. Not always the case, but in general, I would say that is true. And so if you wanted to look at it with puts, you'd turn to page 87. And if you don't have it, you can always go to optionsplaybook.com. If you don't have the book on your desk, you can always go to optionsplaybook.com and you can check that out. So we'll know fairly quickly on this one. I will take a screenshot of the trade that we talked about for our paper trade for this week. And then we'll see what Nike does tomorrow when they announce earnings and see how this trade fared out. So that's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show, question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. That's theoptionsguy@invest.ally.com. Thanks for listening, and we'll be back same time, same place next week. Until then, may all the options you bought finish in the money, and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.